Up now is part 2 of my interview with Warren Mosler, president of Valence Incorporated. Now, in this segment, I first asked Warren why he thinks the Saudis have moved to spread pricing that effectively turns them into price takers. Take a look at what he had to say.
It's to thinly disguise the fact that they're setting price. If they just announced a price, it would be obvious they were setting price. This way, they say, oh, we're selling at the market. You know, we set the discount, and then we just sell at the market. Well, sort of. But it's enough to fool the world. I mean, nobody else but me, I guess, thinks that this is how they do it. So they've been successful at disguising their policy.
Do you think geopolitics is a big factor here, Warren?
Yeah, you know, on a look back, in my 40 years, it always has been, but you don't know until after the fact, right? So probably, but I can't say. But, you know, what's interesting is I posted on my blog a couple of months ago that when the news was coming about U.S. crude output reaching record highs and we're soon not going to be an importer and whatnot, I said, you know, if I were the Saudis, I'd just lower the price, you know, and put all those guys out of business and do it, you know, long enough and inflict enough pain and enough losses on the investors so they'll never invest again, realizing it's too risky. And then you can raise the price to whatever you want. Now, I just put that out as something I would do if I were them. And then, of course, 2 weeks later, it starts happening. So I've gotten a lot of calls and emails about if I knew anybody over there. I don't know anybody in Saudi Arabia. I've had no contact with them whatsoever.
Excellent. Now, what do you expect to happen to the oil sands and shale oil capex with these prices doing what they're doing at these levels?
Okay, so I have secondary information. I read the Wall Street reports and whatnot, and it looks to me like there's at least 200 billion of capex that could vanish. And we've already seen drilling rig counts down 40%, and it'd be a serious problem for the U.S. economy. That's been one of the sources of credit expansion that's been driving things, and without it, and it's been driving employment, and without it, we could have a pretty serious collapse here. And the benefits of the lower price, I think, are more than offset by those kinds of losses, just from what I've added up back of the envelope, even though others are insisting, no, it's just like a tax cut. Now, the other thing I put in that blog is there's an important reason why it isn't just like a tax cut. If oil had been sold at the market based on the available quantity, then the price would have reflected a price that was quantity constrained. At that price, that's all there is. And to get more quantity, you have to go to a higher price. And so GDP was a function of that price and that quantity, and that's fine. That's the way it works for most everything. Okay, but it's not set that way. The Saudis are a monopoly, and quantity was not constrained. It was unlimited crude available at their price at all times. When it was 110, you could call them up and buy all you want. It was price setting, and quantity was not constrained. Okay, so you know that means that because suddenly quantity is released, you know, unless the quantity goes up, it's not going to help GDP. It's just going to redenominate other prices downward. And so when the price of oil goes down, all kinds of other prices fall, and it's kind of like a neutral event in terms of just redenominating everything according to the price of oil. Now, it's not a perfect thing, and there are a lot of rigidities and inflexibilities. It's not a straight line. So you will get a little bit of that tax effect at first, but over time with the adjustments, I think you'll see in this economy that the price level pretty much adjusts to the price of oil over time. And everything's directly or indirectly made out of oil and energy prices. And so it does take time, but it adjusts to it. So you don't get that GDP increase. Yes, it helps the consumer, but it's going to hurt a lot of other people on the other side. And it's somewhat of a wash. Now, the U.S. is a net importer of only 5 million barrels a day. But it's still a lot. And we're going to save some money on the price break, which is good. But if it cuts into our quantity, we're going to wind up importing more, then we have to pay for that extra. So that makes up for the price we pay on the first 5 million. If we wind up needing another couple of million and have to pay $60 or $70 a barrel for that, then that makes up for the discount we got on, we enjoyed on the first 5. And so it's not, to the extent that it causes us to need to import more, it's not a gain. Okay, now some countries will be hurt.
I would argue that Europe, they'll be the ones who are going to be helped the most, obviously, because they are pure net importers. Japan is another example.
And Japan, yes, I agree, I completely agree. And then you've got the Mexicos, Canada, and Middle East countries, all the producers, net producers who get hurt. the United States is a large producer. And of course, the immediate thing on the price break is the GDP from all the oil wells coming out. The reporting gets cut. What's that, 0.4% or something like that?
Right.
It's reasonably serious number.
Now, what about Russia here? The ruble's dropping. Yeah. Banks are having their liquidity constrained because of sanctions, and obviously oil revenue is falling, but not in ruble terms, right? Because of the currency. Yeah. How does that all pan out when you look at it?
Well, I think that Putin has lost some power over there, and he doesn't have as much influence as he used to have. And there are others influencing what he does, and that he has to answer to. And I believe that they're dollar-based, and they're exporters. And when the exporters are in control, things happen that aren't necessarily good for the macroeconomy. Because all exporters want is lower cost domestically so they can export what they have and get a better price. When they see the price of their oil going down like this, they're not happy campers. Now, they are seeing their real wages going down for their other exports. And, Russia, if you're an exporter, you don't actually need the rest of the world. You only need the rest of the world to the extent that you're importing, that you need their imports, because you're sending them real goods and services. And so if you have to look at how Russia gets hurt, it's what kinds of imports have they been enjoying, let's use that word, that they'll have to cut back on because they don't have the foreign exchange to pay for them. And I don't think it's a whole lot. There's some things involved there, but I don't think it's a whole lot. So in real terms, I don't think it's that bad for them over time. Yeah, the initial adjustment is not good, and a lot of people with a lot of serious power are getting hurt, and they're going to have their influence on policy. So you could see things happen because of that. But just from a macroeconomic perspective, they've been using their money to build a surplus, and rather than to import. So I don't see the lack of imports because of this being anything major.
Okay, great. Warren, if the U.S. economy does better than expected and the Fed raises rates, common wisdom is that this is going to be a tightening of policy. But it could be an accelerant by raising interest income for U.S. households. What do you expect to happen?
Yeah, I think if they, I disagree with their reason for raising rates. I think there's weakness. They're raising rates because of strength. But that said, as you said, because I think there's weakness, raising rates would actually cause strength. So I should be in favor of raising rates, except I'd rather have a big tax cut than a hike in interest rates. That's just my bias. But yeah, so if they raise rates, the government's a net payer of interest, the economy's a net saver, large net saver. To me, all the historical evidence is that higher rates support the economy, support aggregate demand, employment, and output. Although it's not my first choice for how to do it, because you're giving money to people who are doing nothing. I'd rather have a full payroll tax holiday to give the spending power to people who are working and producing things, but that's politics. That's not economics. And so if you go back to Greenspan, for example, the economy picked up and accelerated after he raised rates. And if you look at Japan, they've had zero rates for 20 years, and it hasn't helped. And like I said, the same with the U.S. and with Europe. And if you look at the countries that kept higher rates through the crisis, they had a lower drop. They had lower drops in aggregate demand and did a lot better and recovered in nominal terms, whatnot, because the higher rates do support aggregate demand. So I agree with you on that.
Okay, great. And I would also say, and this would be interesting to hear your take on it, there's also the lock-in of rates as a credit taker. If you think that rates are going to go up going forward, and potentially that means also real rates are going up, wouldn't you want to lock in the lower rates, and therefore credit actually gets expanded, gets brought forward, and you'll see that accelerant actually causing real GDP to go up in response to a rate rise?
Yeah, so you would get the credit expansion. But of course, GDP only goes up if that money gets spent on something.
Right.
If you're just locking in a rate or you're just borrowing money to build your cash reserves, then it won't change GDP, right? It's just an interest rate arbitrage on your part.
That was Warren Mosler, president of Valence Incorporated. Time now for today's big deal.